First Horizon just dropped their Q2 2026 earnings, and it's a massive top-line beat. EPS is up 20% year over year, hitting 54 cents a share.
Yeah, that's a really solid jump.
Right. And total reported revenue came in at $887 million. If you adjust that for their tax-exempt income, what they call FTE, or fully taxable equivalent revenue, it's actually $890 million.
Which is, what, a 3% bump from the first quarter?
Exactly, 3% up. And looking ahead, management reiterated their full-year guidance. They're still expecting that 3% to 7% adjusted revenue growth, flat expense growth, and they're maintaining that core CET1 ratio at about 10.5%.
I mean, on paper, those headline numbers just paint a picture of a bank firing on all cylinders.
But, when you're analyzing a regional bank right now, top-line revenue only tells you how much money moved through the building. It doesn't really tell you how much of it they're keeping.
Right. The real story is always in the underlying mechanics, like how are they actually funding this growth?
Exactly. So that's our mission for this deep dive. For you, the retail investor, we need to look past the top-line beat. We're tearing down the segment performance, looking at their margin compression, the strategy behind their hedges, and running a hard diagnostic on the risks buried in the balance sheet.
Because if you're holding this stock, you really need to know what happens to their margins when the economic winds shift.
So let's start with the core engine, which is net interest income, or NII. They brought in an FTE net interest income of $679 million.
Right, which is up $9 million from Q1.
Yeah, and that was driven by some pretty aggressive loan growth, right?
Oh, absolutely. Average loans grew by $1.5 billion just quarter over quarter. They're sitting on a total average loan balance of $64.7 billion now.
Wow.
And if you dig into where that growth is coming from, it was heavily pushed by the commercial side. We're talking about a $710 million increase, specifically in C&I or commercial and industrial balances.
So businesses in their footprint are definitely borrowing to grow. The loan engine is humming. But here's where the math gets a little tricky. They generated more interest income overall, but their net interest margin, the actual percentage profit they make on those assets, it compressed by 3 basis points, dropping to 3.49%.
Yeah, that's that classic banking squeeze we're seeing across the whole sector right now.
It's like a retail store, right?
Yeah.
They're selling a lot more units than loans, but they're making a slightly smaller profit margin on each unit because their wholesale cost just went up.
That's a perfect analogy. For a bank, that wholesale cost is deposits. And the interest-bearing deposit rate First Horizon had to pay out rose 5 basis points to 2.33%.
Which hurts the margin, sure.
Yeah.
But they did successfully bring in $1.6 billion in new deposits, right? Pushing their total to $68.1 billion.
They did, yeah. But you really have to look at the composition of that new funding. It wasn't just, everyday people opening free checking accounts. That growth was heavily driven by a $2 billion increase in brokered CDs.
Wait, brokered CDs? That's basically wholesale funding. That the bank goes to a broker and says, we need cash right now to fund these commercial loans, and we'll pay a premium for it.
Exactly. It's fast money, but it's expensive money. You don't have to build branches to get it, but you pay top dollar for that instant liquidity.
So I'm looking at this, I have to ask, is leaning on $2 billion in expensive brokered CDs to fund commercial loans actually a sustainable strategy? Or is this just management scrambling for a temporary fix?
Well, it sounds like a red flag, but to understand if it's sustainable, you have to look at their massive core deposit base, not just the new money. Management noted that they had $30 billion in existing deposits eligible to reprice this quarter.
Wait, $30 billion? That's almost half their total deposit base just sitting there vulnerable.
Right. Those customers could have demanded higher rates or walked away. But here's the kicker. They retained 96% of that $30 billion without raising costs on those specific balances.
Oh, wow. Okay, so they completely ring-fenced their cheap legacy funding.
Exactly. They held the line on $30 billion of core deposits. That incredible discipline is what gave them the flexibility to go out and buy that $2 billion in expensive brokered CDs just at the margin.
Okay, that changes the narrative completely. So the loan engine is running on this mix of cheap legacy fuel and expensive wholesale fuel. But relying purely on loan margins leaves them totally exposed if the Fed changes rates.
Oh, totally exposed. Which brings us to their non-interest revenue, the fee income, and how they hedge that risk.
Right, so fee income hit $211 million, which is up $16 million from Q1.
Yeah, and part of that was a nice $3 million increase in brokerage, trust, and insurance, mostly from wealth management.
But I want to zero in on their fixed income fee revenue. It actually dropped by $7 million, down to $46 million.
It did, yeah.
And in their commentary, management always highlights these countercyclical businesses, fixed income, loans to mortgage companies, mortgage banking.
Right, the hedge.
Yeah, the strategy is that these segments act as a counterbalance to protect them when rates decline. But if fixed income's down 14% this quarter, I mean, is this countercyclical engine actually just a myth? Is it a theoretical shield that isn't firing?
It's definitely firing, but it's firing exactly the way it was designed to. You have to look at their balance sheet like a giant seesaw. 58% of First Horizon's loan mix is variable rate.
Meaning the interest they charge floats with the broader market.
Exactly. So right now, with rates high, that side of the seesaw is incredibly heavy. It's pulling in tons of cash, which is why we saw that $9 million jump in NII.
Right. But if the Fed cuts rates, those variable yields drop instantly, and that side of the seesaw gets dangerously light.
Which is exactly why they built the mortgage and fixed income businesses on the other side. When rates drop, refinancing booms, bond trading picks up, suddenly that side of the seesaw gets heavy and catches the falling revenue.
Ah, I get it. So the drop in fixed income right now isn't a failure. The countercyclical hedge is basically dormant by design because rates are still high.
Exactly. You don't expect a mortgage refinancing boom at the peak of a rate cycle. It's a structural counterbalance waiting for the macro environment to shift.
That makes total sense. So we've got a humming engine and a prime shock absorber. Let's look at expenses, because none of this matters if they're bleeding cash on operations. How much are they actually keeping?
Well, expense discipline is critical right now. Total non-interest expense hit $531 million, which is a $26 million increase from Q1.
Let me push back on that for a second. We just noted at the start of the deep dive that they reiterated full-year guidance for flat adjusted expense growth, 0%.
Right, they did.
But Q2 adjusted expenses just jumped by $26 million. How realistic is this flat expense goal? Are they just painting a rosy picture here?
It looks contradictory, sure, but you have to break down that $26 million. They cited a $10 million bump in outside services tied specifically to a marketing campaign.
Okay, so that's highly seasonal.
Exactly. Banks front-load marketing to acquire accounts, and then it tapers off. It's not structural bloat. And they also had a $14 million increase in deferred compensation expense.
Which, usually, deferred comp increases make investors nervous when expenses are supposed to be flat.
They do, but deferred comp is almost always linked to broader market performance and usually offsets with gains in non-interest income. It's an accounting mechanism, not them just jacking up base salaries across the board.
The core run rate expenses, the real estate, the base payroll, that's what's actually staying flat.
Precisely. And on top of that, CEO Brian Jordan outlined a specific $100 million plus pre-provision net revenue, or PPNR, opportunity.
So trying to wring $100 million in new core operating profit out of the existing machine, how do they do that without expanding headcount?
By just making the machine run hotter. Like, they highlighted commercial real estate pricing enhancements, which they expect to have a $2 million plus impact.
Meaning they aren't necessarily issuing more real estate loans, just getting better at pricing the risk on the ones they do issue.
Exactly. It's an efficiency play. They also cited treasury management momentum for about a $5 million annual impact.
And for anyone who doesn't know, treasury management is a massive profit center. You give a commercial client a loan, but then you also manage their payroll, their receivables, their fraud protection.
Right. It generates incredibly sticky, recurring fee income with very little new overhead. And they're also targeting another $5 million annualized through deeper cross-selling between regional and specialty teams.
So getting that commercial loan client to also use wealth management.
Yep. That's how you generate positive operating leverage without building 20 new branches.
It's an elegant strategy.
Yeah.
But before we celebrate $100 million in efficiencies, we have to verify the foundation isn't rotting. You can't celebrate high loan yields if those loans are defaulting.
Oh, absolutely. The risk check is everything.
So let's look at asset quality.
Well, if you're looking for stress in the system, you really aren't going to find much here. Net charge-offs were just $33 million for the quarter.
Which is what? 0.20% of total loans. That's up a microscopic 2 basis points from Q1. For a retail investor, that's like hiring a home inspector for a mansion and they find a hairline crack in the driveway.
It's pristine. But charge-offs are backward-looking. You have to look at non-performing loans, or NPLs, to see what's currently in jeopardy, and those actually decreased by $75 million.
Wow, down to $531 million.
Yep, bringing their NPL ratio down 13 basis points to just 0.81%. Plus, their provision for credit losses was flat at $15 million.
Okay, but here's the data point that really caught my eye. The allowance for credit losses, the ACL to loans ratio, actually dropped to 1.24%.
I know where you're going with this.
I mean, the ACL is their rainy day fund. With all the macro uncertainty and inflation right now, why is management reducing their safety cushion? Lowering the ACL artificially boosts earnings on paper?
Sure.
Are they manipulating the quarter by releasing reserves?
It's a totally valid suspicion,
Yeah.
but you have to connect that falling ACL directly to those falling non-performing loans we just talked about.
Because the actual distressed assets are being resolved.
Exactly. The ACL isn't just a jar of cash they fill based on their mood. It's a dynamic reserve tied to the current loan book's risk. Since NPLs dropped by $75 million, borrowers are either catching up on payments or the debt is being restructured.
If non-performing loans were rising and they dropped reserves, that would be a glaring red flag.
A massive one. But because asset quality is demonstrably improving, a lower reserve ratio is mathematically required.
Makes sense. And heeding that kind of risk reduction frees up capital, right? They maintain their CET1 ratio at their 10.5% target.
Right, and because they aren't hoarding excess capital for bad loans, they executed $100 million in share buybacks this quarter at an average of $24.52 each.
Buying back 9 figures of stock while funding $1.5 billion in new loans broadcasts a lot of confidence.
It really does.
All right, let's pull all this together. First Horizon delivered a really clean quarter. 12% year-over-year bottom line growth, solid C&I loan volume, and improving asset quality.
All while successfully navigating that 3 basis point margin squeeze by ring-fencing their core deposits.
Right. But I want to leave you with one final provocative thought. First, Horizon just aggressively paid up for $2 billion in brokered CDs to fund commercial loan growth.
Yeah, they did.
If we are truly at the peak of the interest rate cycle, locking in expensive fixed-rate funding now while holding a 58% variable rate loan portfolio is a massive strategic bet.
It's a huge bet.
If rates fall, their variable loan yields drop instantly, but those CD costs are locked in. They are entirely betting that those counter-cyclical mortgage and fixed-income businesses will immediately step up to bat and catch that falling momentum. Will that hedge actually hold when it's road-tested?
That is the ultimate test of this management team's architecture. It's going to be fascinating to watch.
The multi-million-dollar question. Well, if you want to keep cutting through the noise and understanding the mechanics behind the market, make sure you follow the show for our daily no-fluff earnings coverage.